Welcome back, traders and investors. We have Adam Grimes on the line. He is Chief Investment Officer at Waverly Advisors. 18 years of experience in the industry as a trader, analyst, and system developer. Adam, how you doing today?
Good morning. I'm doing well. How are you doing?
Doing good. Thanks for coming on the show. Just give us a little bit of your education and your background in the markets.
Sure. So, kind of the short version of the story is I started trading for my own account and really had no idea what I was doing, had no idea how markets work, how information worked, blah blah blah. And after a lot of initial false starts and mistakes, I was fortunate to figure some stuff out. And the rest is kind of history. And it was started trading futures, and eventually I've been very fortunate to have pretty much traded everything: futures, options, stocks, currencies, and also have spent many years day trading and many years trading on longer time frames. So kind of been around the block. Yeah, I spent a couple years at the New York Mercantile Exchange, which were kind of interesting times right around 2007. So
Okay.
that's a little bit of my story.
Okay, so do you just get sick of trading one thing and you want to move on to something, a new challenge, or do you just you just apply your strategies to something else? And currently, what are you trading?
Well, sometimes it was driven by both by personal decisions. Do you really want to live your life glued to the screen every second? But also by research, where I found the best edge for the kinds of strategies that I was doing. Because one of the things that I would challenge in traditional technical analysis is the idea that everything basically always trades exactly the same, and you can apply any tool or technique to any market, any time frame. I have not found that that is true, with perhaps a few exceptions. Part of it was a little bit of trying, especially in the beginning, trying to find my edge, trying to find where I really fit. And then there were sort of the realities of personal situation for a while too. And right now, my work with Waverly Advisors, we basically focus on all global liquid asset classes. So we look at stocks from from the broad global level all the way down sectors, industries, individual names, and then currencies and commodities as well. So that experience is now serving me well as we basically look at and trade everything.
Okay, so you have to come up new techniques for for the different things that you're trading or develop new strategies.
Well, it's more of a very subtle difference. Like one of the things I think people are very aware of is mean reversion. That if you have a market that makes a big move, there's a good possibility over the next trading days, or if you're an intraday trader, over the next hour, whatever time period you're looking at, that a significant portion of that move will be reversed. And that force of mean reversion is a lot stronger on some time frames, and it's a lot stronger in, say, stocks than many commodity futures. So it's a matter of understanding the behavior of each market you're trading and making relatively small adaptations. It's not like you have in most cases, the stock system and the currency system, but it's understanding how to apply the tools to the different markets.
Okay, so tell us about your trading systems. What are they based on? Are you a black box, gray box, discretionary trader? Tell us about your trading systems.
Well, I think something that is a little bit different about my work is that I do a combination of very deep, very hardcore quantitative work with human discretion. And I think you have a lot of discretionary traders. I think you have a lot of quantitative traders, but I think there is a real edge that maybe has not been quite as fully explored in the intersection of that discretion and quantitative work. And the reason, of course, is that when you add, the reason it's a little bit difficult to explore is when you add the discretionary element, you're adding something that's a little bit difficult to quantify. So, as a statistician and a researcher, it goes against the grain a little bit, but there really is a tremendous edge there. I do, and with our work we publish, we do a combination of what I would not really call black box systems, but very simple algorithmic rule-based systems. And I say simple, they're at the same time they're very robust, meaning that if we were to tweak or change inputs in the system, we wouldn't see a lot of change in the performance. They're stable over different time periods, So there's that, but everything. I'm basically not really comfortable. I would never trade a black box, and I've done some development work along those lines. But for me, what really feels right is having that element of human discretion. And then, of course, there's all these behavioral issues we can talk about if you want to get into that.
Okay. All right. Moving on here. So you do different time. Are you still trading over multiple time frames? And if you do, I mean, do you keep separate accounts? I know that Dennis and I kind of keep a swing trading account, a day trading account, and then also our longer term investments account we try never to look at. Is that the way you do it, or do you just mix everything in together?
Well, I think the thing you have to be very clear to separate the intent and the idea behind each trade. And people get in a lot of trouble if you, for instance, get into what you think is a short-term scalp, and then as it doesn't work out, you migrate it up in time frames.
Yeah.
And I call that the time frame justification system. And I've seen people legitimately think they were risking a few $100s and take five-figure losses with something like that. You're going to hold something a few minutes, it turns into a few weeks. So it is what you're saying is very, very true, and it's very important to whether you actually segregate it into a separate account or it's somewhere in your accounting system. You have to understand what you have on that, and separate accounts does make a lot of sense because there's a lot of times that you may be you could very well be long something on one time frame and short on another. And sure, you can net out the exposure, but the accounting nightmare is a little bit easier if it's separate accounts.
Okay, and you talk about scalping, and boy, oh boy, has that changed over the last few years. I mean, I can go back when you traded in eights, and that was great. You could sell eights and quarters, and then it went to teenies, and the eights and quarters became teenies and eights, and now we're in the decimal laden world. Just talk about how scalping has changed over the last few years, and do you do it as much of it as you used to?
I've never really been a big scalper. It was something that always interested me from a development standpoint, but there are real problems with scalping. And in some ways, if you think about it, theoretically, with the increased access to markets, with decreased commission costs, transaction costs across the board, there should theoretically be more of an edge for the human scalper, but we just don't see that. And it's always a game where I think you hear a lot more about people who are doing it successfully, and then when you try to nail somebody down, it's a little bit hard to find people that are making a lot of money scalping. I just don't really think the edge for human scalping is there. And part of it, as you said, is quarters to eighths to far less than pennies in some cases.
Yeah, far less.
And
Yep.
it's just not really there.
Along those lines, let's talk about high frequency trading. Do you think that overall has had a negative or positive impact on your trading, or none at all? And just in general, what's your view of high frequency trading?
Well, in general, it's easy. Every period of the market there is something that people complain about. There's something that people are scared about. And it's interesting. You never really hear anybody talk about how well they're doing, how much money they're making, and they hate high frequency traders. That's not the conversation. The conversation is always, I'm losing, they're taking my money, and I really hate the high frequency traders. So I think this points to something very interesting in human psychology. There's always this urge to kind of externalize things, to place the blame on somebody else, somewhere else, which is no formula for success in any endeavor, and it's certainly not in trading. You can make an argument both ways with high-frequency trading. I think one thing that gets lost is that a lot of what we call high-frequency trading are actually order execution algorithms. And there's this idea, I think, that high frequency traders, it's some James Bond type of villain who's running a nefarious machine. In reality, a lot of your high frequency traders, their orders being done for you. Their orders being done for the public. They're large mutual funds, they're retirement funds, they're pension funds. They're also orders being done that let us, balance and hedge and have these exchange traded products that everybody loves and trades and have been such a huge boon to the marketplace. If there's no high-frequency trading, then it's very hard to manage a product like that without market impact. So yes, there's high-frequency trading for profit, but a lot of the high-frequency trading is actually overtly good for the public. As for the trades for profit, so people have figured out how to find an edge if they're making money. Is that really such a bad thing? We could have an argument about liquidity. Certainly some of the liquidity is predatory. To me, there's a difference between seeing size displayed in the book and knowing you can execute there, or knowing somebody is going to chisel you over and over and over. But two, if you go back to the days of the floor, that's kind of the way it's always been since the beginning of time. It's just a little bit faster, a little bit different. And I do think that, back to your scalping question, it's very hard for me to understand why, there are things we do so well as a human, and there are things that our big soft brains can process and think and do well. But scalping is really that's the realm of the silicon brain. Why would you want to compete with something that can literally see and execute and cancel 1,000 orders before you even see the tick on the screen? It just, the speed game makes little sense.
So you don't think the market's rigged then?
Of course the market's rigged. All markets are always rigged. All markets have always been rigged. I think one of the one of the big mistakes is to assume that the markets are fair. The markets are rigged, and you understand that you're going to have to work within. It's like you walk into a shady poker game and it's shady, and you conduct yourself a little bit differently. I think if people understood and we're more comfortable with the fact that the markets are, to some degree, quote, rigged, that's just the reality. Now, on the other hand, I think I would go a step further and say that, yes, the markets are rigged, but to a very large extent, that doesn't really matter, because the executing correct discipline in the market, doing the right things, managing your risk appropriately, those things are certainly possible even in what we're calling a, quote, rigged market here. And it really comes down for the individual trader, or even the institution, to just having an edge and executing that edge and doing the right thing. And we can have philosophical discussions about whether the market's rigged or not, but I don't know that it actually matters at the end of the day.
Okay, let's just go a little short-term and long-term view of the market. New all-time highs again last week. We are pulling back. It's just, we pulled back just a little bit off the highs here. The buy the dippers resting the market yesterday. S&P futures pulling back 8.5 points today. Are you think we've seen a little bit of a short-term top and going to take back some of that huge unexpected gain in August?
Well, I think it depends on your time frame. This goes back to our discussion earlier with, having separate accounts. And so you have to clarify, are you a long-term investor? And if we're defining that, I guess I would say a long-term investor is anybody with a time horizon of realistically more than a year, but let's even say 6 months. So 6 months plus. If you're that long-term investor, then what you need to realize is that stock markets are in bull mode. They're going up. They're making higher highs. They're holding higher lows. Certainly with some exceptions, there's always going to be cause for concern. There's always going to be dissension. The day we come in and everybody in the world is bullish is the day the market stops going up. So, I think that long-term investor has to kind of insulate himself from the news and not really pay attention to the concerns people are raising. Now, it's a much more interesting picture in the shorter term, and if we're looking at the next 2 or 3 months, one of the things you have to realize is, statistically speaking, when stock markets make new highs, they pull back. That's just what they do. There's actually a fairly strong edge to shorting stocks that make new 52-week highs and to shorting indexes there. So it's no surprise whatsoever to see the market pull back. And the way the market is pulling back here is indicative of a certain amount of underlying buying pressure and support. And yes, we certainly could have some shakeouts. We could have a 20-point down day in the S&P. I have no way to predict that. I have no way to really see that coming. But if we have another day like that, we had days like that in the middle of the summer, the day in July. The action after that is going to be very important. But there's no reason that I can see objectively. We can come up with all kinds of fears and reasons maybe we should be afraid, but there's no objective reason to be in any mode other than, quote, buy the dip mode at this point, I think.
Okay, just any favorite books on trading or something you would recommend to our listeners if, just to get a little different flavor on the markets? Do you have any authors or publications that you like to read or follow?
Well, I think, again, it really depends on who you are as a trader and where you are in your course of development. For technical traders who are maybe looking for a little bit more of an objective approach, I would point out my own book. For people who are wanting to, I think there are no books that are better than the Market Wizards series for really getting a sense of the struggles traders go through, the mistakes traders make, and I think people read those as motivational literature sometimes, but to me, really the lessons are seeing other people's struggles and mistakes. And it's always good. We learn from mistakes. We learn from losing money. It's always good if we can learn from someone else's experience and save a little bit of money sometimes. So really a fan of those Market Wizards books. Really a fan of Brett Steenbarger's work. So whether you're reading his blog, which is fantastic, or his books on trader performance, trader development, trader psychology, I think those are some of the best books that are out there.
Okay, all right. We've had Adam Grimes on the line. He's Chief Investment Officer at Waverly Advisors. He has a long history of trading the markets. Adam, what's the name of your book?
The Art and Science of Technical Analysis, and it was published by Wiley in 2012.
Okay, we'll have to take a look at that. Well, thanks a lot for
Thank you.
coming on, and we'd surely like to have you on again.
I'd be happy to come back. Look forward to it.
Okay, thank you, Adam.